In terms of financial results, it's been a very, very strong year for us. I think it's fair to say, off the back of a much, much weaker 2017 result, and there were some extraordinary items, as you'd all know, in that result. We bounced back with a vengeance in 2018. So revenue for us got to 162 million Kina, which was up 45% on 2017. Pleasingly, the net interest income result for us was above our internal forecast, at least at around 22%. Our NPAT, as you would have seen, 48.1 million Kina, which was up 109% on 2017. One of the best results for us internally as a leadership team was the return on equity. So we definitely wanted to get well back into double-digit territory there. So we came in at 18.3, and that sent us on a pretty good trajectory, I think, for the next 1 to 3 years. And earnings per share, final dividend, you've seen those stats. So all round, a pretty good result. Costs, a big focus for us this year as well. The reduction in our cost to income ratio, more pronounced in the second half, actually, when we came in at around 50%, was largely due to the higher revenue growth across the business, and that was certainly the agenda that we were driving with the team. We wanted to kind of maintain our cost growth trajectory, but to kind of lower that cost to income ratio, we needed to really focus more on revenue growth, and I think we achieved that. The strong FX outcome obviously was a contributing factor, and it's fair to say in the second half of the year we did tighten up significantly on discretionary expenditure, particularly following the announcement of the acquisition of ANZ's retail, SME and commercial businesses in PNG, and I'll talk a little bit about that shortly in terms of how that's progressing. And at the end of the day too, we did quite a comprehensive policy review of our procurement arrangements, which helped carve off some expenses as well. We sort of consolidated that into several key suppliers as opposed to the way we were going about procuring previously. CapEx budget, very, very tightly controlled, and as part of the integration program, the board has actually set a risk appetite setting of our CapEx to be no more than 10% of our OPEX amortization as we move forward as well. So we've got some very, very tight management disciplines in play managing that. The CapEx program in relation to the ANZ acquisition and the capability build that we've brought forward as part of that acquisition is seeing sort of 55 to 60 million Kina. So it's quite extensive over the next 12 to 18 months. The forecast is very stable around cost to income. We think we'll land around the same for this year. And that's in advance of working through the finer detail, I guess, around potential synergies from the ANZ acquisition as well. We're starting to do a fair bit of work on that to understand where there may be an opportunity to take some cost out once that acquisition is completed. And the other critical measure for us, which I'm really pleased about, and this will be an outcome towards the end of the year again when we complete the acquisition, is our front to back office ratio will actually be the reverse of what it is today. So currently about 60% of our FTEs sit in what I would call functional or back office type roles. Come the last quarter of this year, that will actually be 70% distribution, 30% back office. And that's kind of where we want to get to in that respect. So 70% of the company, in other words, are in positions of interacting with customers and creating revenue opportunities for us moving forward. Customer growth, again, a good year. So FX income restored, and we grew that by 373% year on year. That was largely as a result of being out of the market 6 months in 2017 when we didn't have a correspondent bank. We spent an awful lot of time in the first half of 2018 just strengthening up those correspondent banking arrangements, and that certainly played out in our favour. I think too, we're batting well above our weight in terms of market share and FX, and that's a reflection of the team we've got, quite frankly. We attracted arguably the best foreign exchange, BDM and PNG from ANZ early in the first half, which complemented our team, and we're just in the process of expanding that team moving forward as well. But we finished the year up around 10 to 12% in terms of market share for total FX. A really good signal to us in terms of market favour was there were a significantly higher number of market interventions by the central bank, the Bank of PNG, following the government raising $500 million US, the first sovereign bond for PNG, and that certainly helped free up a lot of the structural issues that we'd been experiencing. So through those interventions, we've been getting sort of between 10 and 15%, which has been really good. Customer numbers, pleasingly, up 25%. We've had a huge focus, particularly through our branch network and our business partners team on new to bank customers. So we finished up at around 21,000. At the end of the year, it'll be close to 125,000 based on the forecast and the number of customers that we get from ANZ. Deposits well up 29% to 1.31 billion. That was just ahead of our original budget for the year. A lot of success in the second half of the year with the corporate sector. So the rebranding from Kina to Kina Bank, the divestment of Fushan as a 35% shareholder, and the announcement of ANZ, the ANZ acquisition, certainly helped us get, I think, a much stronger relationship with the corporate sector in PNG. And that's where a lot of the domestic liquidity is actually tied up. And pleasingly, we launched a digital cash management account. Most of that funds flow came into the CMA, which is a low-cost transaction account for us in terms of deposits, and hence why we've been able to maintain our NIM at around the same level as 2017. Loans and advances up 20% for the year. That was predominantly in our business lending book. Our home loan portfolio was relatively flat year on year, but I'll talk about that shortly. Funds under management grew to 7.5 billion. You'd be aware we are the lead investment manager for the biggest superannuation provident fund in PNG, number one super, and funds administration grew significantly from 7 billion to 11.4 billion as a result of us taking on board NAS Fund, which is the second biggest provident fund in PNG. So we're now managing close to 750,000 superannuants as part of that business. Risk management, we've kept our credit risk appetite settings, I should say, relatively tight. So to be able to achieve lending growth of 20%, most of that has come as a result of us refinancing, I would like to think, the better customers from our competitors in PNG, BSP, Westpac, and currently as it stands, ANZ. Capital adequacy remains strong. We're forecasting that to be around 18 to 20% when we complete with ANZ, so still a significant buffer in terms of the regulatory requirement. Total provisions, pretty much the same year on year. Same with the arrears and impairment expense, and we have fully adopted the IFRS 9 standards, which did result in our provisioning going up slightly, but not anything untoward by any means. We're in the throes of getting regulatory approval for a strategic partnership with MyBank Nationwide Finance. So MyBank is the biggest microfinance bank in PNG. We're seeking to acquire a 15% stake in them as really a means to comply with a banking license requirement to ensure that we have a financial literacy program. So as opposed to building that ourselves, the challenges in PNG being still today 80% of the population remain unbanked, but a lot of that population are in very remote, hard to reach geographies. We felt it would be better to align with an existing organisation that has a well-established network. They have close to 350,000 customers, so we're aiming to share technology moving forward, and there'll be a chunk of ANZ customers that come across with their Go Money platform, which is their financial inclusion program that over the course of the next 12 months following completion, I should say, so that'll be in 2020, we'll look to migrate those customers across to MyBank as part of that partnership arrangement as well. The exciting opportunity is once we've built our cards acquiring and issuing platform in our POS network, we will actually provide that technology and platform for MyBank as well, which is currently provided by BSP. So that's coming. NIM, as I said, stable for the year, and really a function, I should say, of the fact that domestic liquidity in PNG remains very, very strong. So there's a surplus of Kina, and that's meant to we've been able to keep rates relatively low. We've actually developed a new base reference rate for our business lending book, which we're calling the Kina Business Facility Rate. And it's a completely different way of structuring the market there and pricing for risk. And it'll just enable us to be a lot more, I think, flexible and nimble in the event that we have to move rates up over the course of the next 12 to 18 months, which may come about as the structural FX issue improves. Domestic liquidity will be absorbed. There's a number of major resource projects that will be commencing in the latter part of 2020, which will start to suck up some of that domestic liquidity as well. So we're just preparing ourselves for that to make sure that we're a little bit more agile in terms of being able to pass any potential rises in cost of funds onto our lending, our loan book. The loan book, as I said, it's in good shape. We've adopted the IFRS 9 standards. That was the main reason for a slight shift in provisioning, but certainly no deterioration of our loan quality across the portfolio, and it suggests that our risk appetite settings are still about right and relatively conservative as we build out. In terms of strategic milestones, 2018 was a huge year. So pretty much in the same week, we announced the acquisition of ANZ SME retail and commercial businesses. We resolved the issue we had with the central bank around the escrow shareholding of Fushan Investments, so they ceased to become a substantial shareholder. We strengthened our correspondent banking arrangements, signing up with Crown agents in the UK, and I have to say that's been an exceptional experience from our perspective, but also from customers, and clearly one of the reasons that we've been able to lift our FX income so dramatically. We did some significant ICT digital enhancements to our core banking system. So over the course of 2017, we spent about 3.6 million Kina on that. That's taken us to the latest release, and thanks to the Australian government, once the Coral Sea cable's plugged in at Ella Beach, Port Moresby, we'll be able to deliver some very, very cool digital technology to our customers. A really good example of that I touched on earlier, which was the release of our online CMA account, which you can only transact digitally. And that's been hugely successful, particularly with the corporate sector. We got there in the end, but we successfully onboarded NAS Fund. It took us close to 9 months to complete that transaction. So we're now managing 750,000 Papua New Guineans who are paying actively into the two biggest provident funds in PNG. And pleasingly, we won the Most Innovative Financial Services Company Award for 2018, which was awarded to us by the PNG Institute of Company Directors. In terms of the economy, it's always good, I think, to give you a bit of an update of what's happening in PNG. Stable, so the growth forecast for 2019 is 5%. Our economics department sort of pitching it more around 3%, and this is largely to some of the minor delays with two of the major key resource projects, the Papua LNG, which is sponsored by Total out of France, and the Wafi-Golpu Harmony Gold and Newcrest joint venture, which has been pushed into 2020. These projects combined, along with the third train for the existing Exxon LNG facility, will be around $20 billion US in terms of new investment. So it's going to take PNG, I think, back to where we were 5 or 6 years ago, whilst that Exxon facility was under construction. FX I touched on, it's improved significantly, and there have been far more interventions by the central bank to free up that sort of forward order book for imports. We think the FX market will resume to normality probably midway through this year, by the end of June, I think, is our expectation. Exchange rate forecast is flat and relatively stable. We don't see that changing, particularly in light, again, of the significant investment offshore coming by way of these key resource projects. Political environment is steady. Same government now, they're into their third term. APEC 2018 was very successful. Hats off to PNG. They did an amazing job hosting it. Meant to be a 300 million Kina spend. I think it ended up being close to $1 billion Kina, but certainly the return on investment, very, very positive. I think the fact that we're in a favourable geopolitical position between China and Australia and everybody else means that all of these countries are throwing a significant amount of investment in PNG, and so there's some examples listed there. through China Aid, who basically redid the complete road and freeway network across Port Moresby prior to hosting APEC. That was a significant program of work. The US, Japan, Australia and New Zealand have agreed to electrify 70% of PNG by 2030. And the Coral Sea Cable, which is sponsored by the Australian government, is meant to be plugged in hopefully by the end of November 2019. And ADB just announced a $500 million project to seal the Highlands Highway from Lae through to Port Moresby. There's also a number of other infrastructure projects for port redevelopment and airport redevelopment occurring over the next 2 to 3 years as well. So there's a lot happening, and I think that's just a function of APEC, the increased awareness of who PNG is and where they are, and the battle between China and US over who has control of the Pacific. So in terms of 2019 priorities, I thought I'd just list a few things that we are working on. Clearly, the biggest program of work for us is the ANZ integration program. We've got close to 40 people working on that at the moment, and it's a joint integration program with ANZ on the ground. It's progressing well, and we're on target for a changeover date of mid-September. We're trying to time that actually around PNG Independence Day, which would be great for us from a PR perspective, but ANZ aren't too comfortable with that for obvious reasons. The formal regulatory approval is through, so we received that last week. But regardless of that, as I said, the program is actually quite well advanced across all of the key streams of work. There's a significant internal digitalisation program occurring. We've brought forward some of this CapEx spend to coincide with the ANZ acquisition, and some really good examples of that. Firstly, the automation of GL reconciliations, for example, in finance. We will be launching an online loan origination system and moving to automated transaction monitoring for AML, CTF, and the latest, which is anti-bribery and corruption. So they're big programs of work happening internally within the organisation at the moment. The implementation of our new payment switch, so our new vendor Open Way, which enables us to roll out our POS network and connect to the other commercial banks in PNG. That was completed last weekend and was very successful. That also enables us to now be in a position to issue EMV chip debit and credit cards. So they're in UAT user testing as I speak. The implementation of a new national payments platform by the BPNG is set to go live on the 22nd of July as well. So again, that will just speed up the ability of us to facilitate real-time payments with the other commercial banks in PNG. The key priorities as part of that program are around the technology build itself, which is significant, the operations build out. So there's a number of functions that ANZ presently perform offshore, and this is one of the reasons that we decided to run with our core banking platform. They've got a very complex, it's like a spider web, their technology. They route a lot of data through Fiji, through Mumbai, through Singapore and Melbourne. All of ours will be routed internally from a jurisdictional point of view in PNG. So a number of those roles that they're performing, and it's largely middle and back office, we will be bringing back onshore. So we've just hired 2 key resources actually from ANZ's operations Pacific hub in Suva in Fiji to help with building that capability. And then change management. So we've got some great technical support from IFC and ADB. They're providing a lot of specialist functional support and project assistance for us at the moment, essentially free of charge. So it's donor funded. And we recently announced the partnerships with Visa and China UnionPay, who will be the 2 primary card schemes that we sign up for later this year when we complete, and that will enable us to effectively accept all domestic and international cards. We're very excited about the China UnionPay ability to accept their cards, but also potentially to be able to issue them. There's a massively increasing Asian population in PNG that will be a captive opportunity for us. And the objective through this integration program, and I thought it was important to point this out, because regardless of how complex it is, the aim at the end of the day is to achieve a seamless customer and staff experience. And a really good example of that recently with the town hall I did with ANZ's key staff in their branch network is 3 things will change for them on what we're calling legal day one. When we complete the transaction, there'll be a new sign at the front of their branch, they'll be wearing a different wardrobe, and there'll be a new teller system. But pretty much everything else in terms of our systems and processes will remain the same. For customers, very, very similar. They retain their existing ANZ account numbers. They still retain their blue plastic until it expires. Everything that they did the day before legal day one, they will be able to do after legal day one. And obviously, we're trying to build in an element of the wow factor around capability, which we're very confident we'll be able to do from day one for both staff and customers as well, so that it's a much, much better experience. Now that we have the formal regulatory approval through, we can be a lot more overt in terms of public relations, promoting the brand, promoting our capability, and engaging directly with ANZ's customers. We've already transitioned, or are in the process of starting to transition some of their capability across. Home finance is a good example. They've got quite a big mortgages team. We're moving them across now before we complete, so that if any ANZ customers have a request for a home loan, they'll be directed to what was their team, now working under the Kina Bank brand. And we're looking to do something very similar with the SME and commercial relationship managers as well. The important thing, though, as we run that program clearly is that we continue to drive organic growth, and we have some pretty firm targets in place we've set for the next 3 years. We've created a new personal banking division that the focus of that division is on new to bank customer growth and conversion of a lot of our existing customers as we build out capability to what I would call lead bank customers. Many of those customers only have a small amount of their business with us, whether it's a deposit or a loan, but there's an opportunity to build on that and win their transactional banking. We're targeting home lending for high growth in 2019. That is a huge focus. It was one of the only sort of disappointing things I think for me in 2018 is that we didn't really manage to get a lot of traction. BSP have a monopoly in that space. To put that in context, in their announcement last week, their home loan book is about 2.3 billion Kina. Ours is about 150 million. So we think there's a huge opportunity for us to compete more aggressively and head to head with them. We did have some process issues behind the scenes. We've fixed all of that. So we're ready to go. We launched a very market competitive variable rate last Friday, and we're announcing to the market the first 3-year fixed rate for PNG, hopefully by the end of this month. We've just got to get our products systems right behind the scenes to be able to do that. But certainly growing our market share, and importantly call out, not at the expense of NIM. It's a relatively small portfolio. The mitigant for it is that we have hedged the fixed rate facility, and we're getting 1.3 billion of very low cost, what we call CASA funds, current account and savings account deposits from ANZ when we complete towards the end of this year, which should ultimately improve our NIM, which will be a good outcome. So business lending, we're doing very well in that space. I would argue we've got the best team in the market. I know most of them from my time at a competitor bank and other banks in the market as well. So I think we've hired well. We've got some good talent, and the results we're getting are a reflection of that. We're targeting growth consistent with last year of around 20%. System growth is meant to be around sort of in the order of 6 to 7%, so well above that. And quality business obviously is a big part of it. Expanding our FX and corporate cash team. So we've just hired 2 business development managers to really manage the corporate sector. It's not a huge target segment for us, but certainly for foreign exchange it is, the export sector in particular, and for liquidity as well. That won't be so much as an issue for us come the end of the year, but we've still got some very, very strong lending targets to achieve this year, so we need to be able to fund it. Innovation for FUM and FUA. So we've been fairly quiet on that front over 2018, and the reason for that largely was the onboarding of NAS Fund, which it was no easy feat. Another 350,000 superannuants across onto our security platform. That's all being resolved. So now really it's looking at how can we be a little bit more innovative in that space. We've got an unenviable market share of about 90%, I think, in funds administration, close to 60% in funds management. We want to maintain that position and look for opportunities to continue to grow our revenue base. So there is the potential for a secondary bond market, a potential capital markets, and we're working with the local Securities Commission on that front. And certainly having a proposition, ANZ actually have a very small mass affluent segment called Signature, which we're rebranding as Elite. We want to grow that quite significantly. They've got about 1,500 customers in there. We think there's an opportunity to grow that to around 5,000 over the next sort of 12 to 18 months. So that's coming. The new pricing methodology I talked about in terms of the Kina Bank facility rate, we hope to be in a position to launch that by the end of June. So we'll be announcing that to the market. More broadly, the key for us is structurally it will enable us to be a lot more nimble in the event that we have to reprice our loan book to try and protect our NIM, which is important. I've talked about the early transition of some ANZ PNG functions, which we've commenced on. And we just had a look at our first quarter pipeline yesterday, actually, and that's looking very, very strong, which is good because last year we kind of came home with a wet sail in the second half. The first half was relatively slow.
I guess what we've tried to do here is to show you that there has been growth in the business, and we obviously had a bit of a dip in June in 2017, but the business has got back on track, and that's most important. So the trend graphs basically show that we brought the business back on track. This is purely our organic business, so it's obviously what is currently within Kina Bank. But obviously, once the ANZ business comes on, we expect to see a different trend moving further from this. So in terms of revenue growth, you've seen in this, we've tried to give further detail here in terms of the segregation between interest on loans and interest on investments, because earlier we used to just show interest as one, but then obviously there are different dynamics in the two in terms of the cost of funds that we get. And foreign exchange income obviously is the key standout here over the periods, which has picked up back on. In terms of NPAT, we pulled it back up to 27.5 million in the last year by December, and that's the upward trend which we expect. Obviously, the trend will continue. Earnings per share again brought back to the market levels that we thought we would get to in terms of the. Also, if you look at the earnings that we get on the shares, the yield on the shares, that's doing pretty well through the dividend per share. This year we will be giving a total dividend of about 23 Kina per share, which is 9 cents. And that's again on an upward trend in line with what we had originally predicted. Productivity is obviously a key thing. Greg's spoken about it. That's been the focus of this year. We obviously had to focus in the second half quite a lot in the cost to income ratio, because that's something that the market monitors. The board's been pretty strong about it. Internally, we want to set ourselves a lower benchmark, but we are in a growth phase and we've got to be careful that we don't cut spending too much, because that could compromise the growth investments that we're trying to do in the business, especially in the systems and the technology and the areas and the branch networks expansion that we need to do. We brought some of the costs forward because obviously we need to be ready for the ANZ transition. But despite that, there was very strong control in the second half. This was obviously cost to income was helped by the FX business. So obviously as the income went up, the cost to incomes come down. Return on equity, Greg spoke about. We're back to a position that we want to come to. It's closer to about 22-23%. So we're headed to that direction. And NIM's been managed, and we continue to monitor NIM based on low-cost funding. So the drive is towards low-cost funding so that the NIM keeps improving. So productivity, those are the areas. The balance sheet essentially is still very strong. We said we'd grow the loan book by about 20%. That's what we have done. Going from gross loans from 745 to about 870. And we want to obviously keep shifting this into increasing on the home loan side, and that's going to be the focus this year. There have been challenges Greg spoke about, but that trend is very much there, that the focus in the first half of this year is going to be trying to push that home loan portfolio so that we can, and it is a market we can tap into, because BSP's got just an abnormal share. I mean, at 2 billion in terms of what they've got, and we've got just about 100 million, I think there is definitely room for us to move there. In terms of deposits, we've been very aggressive. We've hired new people who are also going to help on the FX side, and they are really the drivers who will bring through a lot of the growth deposit from the customers also. So again, the trend in both these is on the way up. We obviously, when we get ANZ, there's going to be a different dynamic to play because we are going to get low-cost funds and deposits. So that's something we need to manage. Capital management has been strong. We continue to maintain that. The board's been looking at the dividend ratio. You probably will have seen that the dividend ratio has dropped down a bit this year, and we are still within the 65 to 80% distribution of NPAT. But that's something will be part of our capital management plan and review, because if you've got to fund growth in future years, we need to ensure that we've got enough capital to grow. So that's, and as our business grows, in fact, when Richard called me, he says, if I project this out for 5 years along with the ANZ business, this is going to look like a ridiculously profitable business. I said, yes, it is. But the issue we've got there is that we have to manage our capital management plan accordingly. And so obviously we will be monitoring all of that as we go along, because growth is imperative over the next few years and we're going to have to manage that. So that's, and leverage we monitor alongside what the BPNG minimum leverage ratio is, and that's also pretty healthy at this stage. We pride ourselves on the asset quality. We are very, very strong in our credit management and our monitoring of our credit risk. We are very difficult with what we take on in terms of, unless everything ticks the boxes, we definitely are not going to take on those aggressive loans. As a result of which our loan book has always been strong, despite IFRS 9, and I'm not sure what feedback you guys have got from the market. It's been quite difficult on most of the banks. We have also taken a hit, and that's been reflected in the books, but I think there's more prudential risk there as opposed to being actually endemic in the book. And the auditors also are very confident that structurally the loan book's very strong, but because of IFRS requirements, and some of you may be familiar with that, it's very pedantic, it's very rule-based, and it just forces you to make a provision regardless of the fact that the quality of the loan might be different. So though we are moving to, the IFRS gets people to move to a expected credit loss system, the grading system, it still holds back to the loan arrears methodology to quite an extent. So I think we've got to manage all of that as we go. We don't expect anything to hit our books, but it's going to remain.
Sorry, just a question on that previous slide. That the non-performing loans and loans in arrears, I mean, that's come down from mid-5s down to low 2s now. How have you achieved that, and what's driven that?
So if you see, it's a shifting from non-performing from 60 days, from 5% that we had earlier. It's just monitoring the customers. So it's basically going out with the relationship managers, talking to the customers. So a lot of the paperwork, etc., used to not be inherited a loan book that was probably managed but not properly managed. So as we started contacting the customers more, it was more engagement with them to have all the paperwork in place. So you'll appreciate how a system works, is that if file reviews are not done, or if certain paperwork is not got from the customer, you automatically grade the risk higher. And so the non-performing loans would be considered as non-performing. But as you start engaging with the customers and make sure that they understand the need to have better management of their books and records, it's purely that. It's basically working with them to understand why, if they want to continue with Kina Bank and in the banking system, it's not just us. ANZ do the same, Westpac do the same, BSP do the same. So in terms of record keeping, all that, so primarily in that area.
Yeah, I mean, I can say this because Maybank, who you're aware Kina acquired in 2015, did not have a framework for undertaking any reviews of their larger exposures, and we put that framework in place basically for any exposure above 2 million Kina. So we were quite a strict management regime in play for that, which has been, particularly for those Maybank customers, an interesting transition, because we're asking questions that they're not used to being asked. But that certainly improved, I think, the performance of our portfolio.
It's very basic steps, like even just, they've got the checks written out, someone's going to go and pick up the checks and actually bring it in. Because the old systems used to still, these guys would write out checks. Now moving with digital, there's going to be no excuses. There are going to be standing orders. There'll be other things that we brought in. So the change to a digital monitoring of our business is obviously bringing all the gains that come in because you've got standing orders in the system, which we didn't have earlier. You'd have to go and pick up a check and bring it back. So concentration risk hasn't really changed. Our profile hasn't changed much. It's primarily if you've seen in personal loans that we are trying to grow that part of our business because we are trying to move more into retail banking also because we've had a very strong, a focus towards SME, but definitely the retail book and the other things we're trying to build up. So that's why you've seen the personal banking side increase over the period of time. Real estate, renting and business services still is our largest chunk at about 29%. And so it's we stick very much within very conservative portfolios. So we're not in the extractive industries. We're not with government. So you'll find in those two areas, we really haven't pushed ourselves at all. So we'd stay away from
I think the other thing that I would say there too is that following the ANZ acquisition, that's going to give us a much, much better spread in terms of diversity of our book and industry sectors by virtue of the fact that 80% of business done in PNG is outside of Port Moresby and Lae. And today we're a Port Moresby Lae centric bank, I should say. So Port Moresby is largely a service town. So you would expect real estate, property, etc., to be the driving economic factor in a location like that, which it is. So that position will improve quite markedly, and it's something that we keep a very, very close eye on. We stay away from the bigger land subdivisions and larger property developments for that reason.
I think in addition to what Greg's just mentioned, there's also the government focus on going into the other industries also like agriculture, tourism. So obviously there's going to be investment opportunities there. And then we have to see how our customers actually take advantage of those opportunities. So there might be a further distribution of the concentration risk. Digital strategy, Greg spoke about, is the increase in numbers that we've spoken about earlier, getting close to 21,000 from when we started. And that's consistent with the new systems and things that we're putting through. So market share, we measure both. We measure the lending side as well as the deposit side, steadily gaining in market share. We started in 2016 with just about 3.5% in terms of lending. It's already doubled at roughly about 6.5%. And I think we are targeted to grow further once we get the ANZ side of it. And deposits, similarly, we started with roughly 3% of the market. Again, we more than doubled it, and we see that growing too. And low-cost funds, this is just to give you an idea how we are trying to move into the CASA space, which is the current accounts and the savings accounts. And that's been our focus because we used to be completely term deposit driven earlier, but then we moved through from there to low-cost funds. Funds under administration, we've spoken about, there's been a continuous growth on this. I don't think we're going to grow heaps in the funds administration side since we control 90% of the market already, but it's the cross-selling benefits that we do expect to get from there. Funds under management also, there are restrictions in terms of whether we can be funds managers for all the funds. There could be limitations by BPNG there, but it's still growing as the fund grows. So on an average, number one super adds about 600 million to their net asset balance sheet every year. So by virtue of that, we know that our funds under management are going to continue to go up, and we get a tick on that.